In 1934, a professor at Columbia Business School wrote down a rule for handling money. 14 centuries earlier, a text far older than Wall Street, older than banking as we know it, had already set out the same discipline. Different worlds, different languages, entirely different reasons. Same conclusion. If you invest today in anything, the next 8 minutes explain why those two sources agree and why that agreement matters more to your results than any forecast you will hear this year. Start with the professor. Benjamin Graham taught at Columbia and watched the 1929 crash destroy a generation of savers. Out of that wreckage, he drew one hard line. An investment operation, he wrote, is one which upon thorough analysis promises safety of principle and an adequate return. Everything that fails that test is not investing. It is speculation. Graham had watched people buy stocks purely in the hope that someone more optimistic would pay more tomorrow, and he refused to call that investment. He called it what it was, a wager on the mood of strangers. His antidote to an unpredictable future was the margin of safety. Pay significantly less than a business is worth. Not slightly less, significantly less. Because you will be wrong sometimes, and when that happens, the gap between the price you paid and the value you bought is the thing that absorbs the damage. The margin of safety is not a trick for finding winners. It is a way of surviving your own mistakes. His most famous student took the foundation and built on it. Warren Buffett added 2 disciplines of his own. The circle of competence. Know what you actually understand and stay inside it, because the expensive errors happen just outside the edge of your knowledge. And temperament. The willingness to do nothing, sometimes for years, until the right business arrives at the right price. Buffett's first rule is famous: never lose money. His second rule is to never forget the first. And on borrowed money, Buffett's principle is blunt. If you are smart, you do not need it, and if you are not, you should not be anywhere near it. In his world, leverage is the one thing that can turn a temporary setback into a permanent loss. A business drowning in debt does not get the luxury of a bad year. Its creditors decide its future, not its owners. Now cross to the older source. Islamic commercial teaching rests on a small number of pillars. The first is the prohibition of riba, money earning money purely through interest. Wealth, in this tradition, should come from owning and sharing in real productive activity, not from renting money to someone else. The second is the avoidance of gharar, excessive uncertainty. Do not commit money to contracts whose outcome nobody can reasonably assess, and do not profit from another person's confusion. Close beside it sits the rejection of maysir, gambling, staking money on chance rather than on enterprise, and over all of it sits stewardship. Wealth is held in trust. It is to be deployed carefully, productively, and with accountability for where it goes and what it funds. Set them side by side, and the alignment is difficult to dismiss. The margin of safety and the avoidance of gharar are the same instinct wearing different clothes. One says, demand a discount because the future is unknowable. The other says, walk away from arrangements built on unknowables. Both refuse to commit capital where the outcome is a guess dressed up as a plan. The second alignment is the balance sheet. Buffett avoids heavily indebted companies because debt makes them fragile. The older tradition restricts interest-bearing debt as a matter of principle. Different starting points, identical destination. Both filters remove the same fragile companies, and what passes through both is the same kind of business. Conservatively financed, cash generating, built to survive a storm rather than to flatter a good year. The third alignment is speculation itself. Graham's greater fool is the scholar's gambler. Both traditions look at money staked purely on price movement, with no interest in the underlying enterprise, and reach the same verdict. That is not ownership. It is a casino with better lighting, and both point the investor at the same alternative: the real economy, real goods, real services, real cash flows. One tradition arrives there through evidence, the other through principle, and they arrive at the same door. Be honest about where they part ways, because the differences are real, the motivations differ. Graham and Buffett avoid leverage and speculation because they lose money. The faith tradition avoids them because they are wrong, whether or not they happen to pay. The scope differs too. Value investing has no forbidden industries. If the price is attractive enough, a distillery or a casino operator is simply a bargain. The ethical tradition says no. Some revenue is excluded, whatever the price, because what a business does matters as much as what it earns. And one framework is a set of preferences a person may bend under pressure. The other is a commitment, which is precisely why it holds when markets are euphoric and discipline is expensive. So what does a modern values first screen actually do with all of this? It runs every company through two gates. Gate 1 asks what the business does, where the revenue actually comes from, and whether those activities survive an ethical test that draws on this older tradition. Gate 2 asks what the business is, how it is financed, whether the balance sheet could survive a hard winter, whether the cash flows are real, and whether the price leaves room to be wrong. Passing one gate is not enough. A company must clear both gates, and most do not. What survives is a short list of businesses that are ethically sound and financially resilient at the same time, which is exactly the kind of company both a 1930s professor and a 1400-year-old principal would recognize as worth owning. This is not a framework for one community. The discipline includes Sharia principles, and it belongs to anyone of any background who wants their money to stand for something and to stand up to stress. None of this is a promise about returns. Nobody honest can make you one. It is a framework for asking better questions before your money moves. The full written piece and the ethical hub with the screens and the guides are linked below. Education, not advice. Markets carry risk. Manage your size and do your own research. One more thing before you go. If this earned your attention, subscribe so the next one reaches you. The full written piece and the ethical screening tools are linked below at titanprotect.trade. And send this to the one person who has this argument at the dinner table.